Good afternoon. That was my entire introduction. Now I have nothing left to say. I'm Andrew Webb, along with Oliver and John, as Brad mentioned, to discuss about the tax reform. And as Brad mentioned, you might be aware we have a mildly controversial president who's done occasionally mildly controversial things in the U.S. And as a result of that, we have a new Tax Reform Act. And so there's a lot about it we don't know. There's a lot of gray areas, as Brad said, a lot to still sort of change, most likely. But we'll go through this discussion and as it relates to what we do and don't know for commercial real estate and the impacts thereof. So I think it's fair to start with the fact that it's largely misunderstood for the most part. A lot has changed, but a lot hasn't changed. So John, starting the conversation, tell us a few things that haven't changed with the tax law.
Yeah, I think it's important to dispel some things going around in the market, because I'll get real estate developers and others, particularly in Europe, that'll say, oh, I heard FIRPTA was repealed, you know, the US tax on real estate investments. And you go, no, so you can't deduct interest anymore. No, that's not quite right, et cetera. And the other one that is not quite apropos to the question, but I think it's important to understand there's a misconception, particularly in Europe, that because this overall effective tax reform is good for real estate, that this was something done for Trump. Knowing a number of congressmen, including Republican congressmen, I'm not sure that any of them want to raise their hands and say they've done anything for Donald Trump. I don't think he's quite loved in Congress. Whether or not, you know, where you are on the political spectrum, he's polarizing figure, but I think people in Congress pass tax reform for themselves. Imagine that, congressmen looking after themselves. So moving on from that, things have not changed in a number of areas. The rate's gone down, but the interest deduction, which we'll talk about in a minute, is still there, subject to some limitations. The withholding tax rates have not changed. That's a common misconception. Even though the federal rate of corporate tax has gone down to 21%, there's still a 30% gross withholding tax. FATCA has not been repealed and is not going to get repealed. I don't see that happening anytime soon. Depreciation, again, we'll talk a little bit more about that in a minute, is changed a little bit. There's a bit of an acceleration on some things, but the basics of how depreciation works in the States, that hasn't changed. So I think it's important to understand that, as has been mentioned before, there's fundamental reform in that we've reduced rates and we've changed things on the international side. But for real estate, it's all about making things a bit more favorable within the existing regime.
And so part of that, I mean, we know that part of the reason for tax reform is to invigorate an economy, spur investment, hiring. Ultimately, if you're a Republican, they'll tell you to put more money back in the people's hands so that hopefully they spend it, they increase the US GDP. We've already seen some of that with a number of companies giving back some of their savings and revenue to their employees in one-time bonuses. Walmart, AT&T, Wells Fargo have all done it. But Oliver, so far, how would you describe the overall impact of the tax reform on the U.S. economy, and as John just mentioned, particularly to commercial real estate?
So I think Frank and also James earlier mentioned that already a little bit. There was quite some frenetic energy surrounding Trump's administration's tax reform when it came out. But if you listen to some of the Fed's economists, they only see the forecast only a very short-term boost to the growth in the US. I think they project like 2.2 to 2.6% roughly growth in 2018 and a softening in 19 to like 1.6%. So the question is, what's the long-term impact positive on the economy in the US? That might be, you know, people have different views on that position. Also, we are now in a late cycle territory, I think, when it comes to the most recent expansion, which is now nearing almost 9 years. While since World War II, all the expansion cycles had only 5 years, roughly 5 years, if at all. So that kind of suggests that we come to an end at some point. So I believe tax reform may have injected the last kind of gallon of fuel to an extension of that cycle. Also, if you look at the debt intake since 2010 by firms, corporate debt, almost $8 trillion with only $3 trillion of new equity injected. So there are a few choke points, I think, that might project that the expansion in the US economy comes to a softening. What does it mean for real estate? I think we had a survey recently done with Emerging Trends, and they said, so 61% of the respondents said tax reform is good for real estate, only 7% said negative, and about 32% said we are unsure, we don't know yet. It's tough and too early, I think, at this point in time to quantify the impact tax reform may have on real estate. But if you look at tax rates, just 30 numbers, 35 down to 21, most investors will see an improvement of post-tax IRR clearly. That's a good thing. But overall, I think there is now new hope that real estate will continue to thrive in the next 12 months or 2 years potentially. It's certainly sector dependent as well. So if you look at the respondents to a Preqin survey for 2017, 50% view industrial, like was mentioned earlier by James, I believe, as very at the best opportunity in the market. 44 said it will be office, and only outdone by residential, saying about 56% of respondents said that's the best market to go in, residential. We'll see. I talked to a sovereign last week, and it was interesting to hear them to say we are concerned with the pricing on the east and on the gateway cities, like mainly the blue states, New York, California, due to the loss of what I think maybe John will mention later, the loss of the state and local tax deductions, which will have an impact on housing and real estate ownership by individuals. So they actually intend to underwrite or price in the underwriting like a 5% discount when it comes to the next 4 or 5 years. So they're kind of projecting there will be negative impact to pricing when it comes to mainly the blue states and where they're heavily concentrated.
Yeah, I guess jumping ahead on that just for a second, is that one of the things that came out that people don't think about as much unless you're a partner in a law firm or an accounting firm and have to pay taxes everywhere on earth, is there's a limitation on how much state and local interest or state and local taxes you can pay as an individual. Now, for corporations, the law hasn't changed. In fact, the law has gotten a little bit easier because of some other changes. But for individuals, because you've got to remember, these are voters. There's a cap on how much state and local tax they can deduct. So states are looking at this, and Georgia just passed tax reform overnight as to what do to raise money, because there's only so much that they can do to deal with this for individuals because they're voters. Do they raise tax rates on corporations? Do they raise real estate taxes for businesses or something else to try and make up the difference? And in particular in Gateway, you look at like New York State, you look at Illinois, you look at California, fiscally they're basket cases. And they can't really reduce their tax intake. In fact, they have to up it. So where does it come from? And this gets back to another point of when the tax rate goes down to 21% for federal, what if the corporate rate in Illinois goes up to 12? Then you look at state and local tax becomes a much more important part of your consideration. And then therefore, the jurisdictions within the U.S., going back to the outline and the little kites, like where would you invest? Because maybe that's going to change the calculus.
To your point, just recently, since January, we see a huge increase of our activity when it comes to redomiciliation, relocation activity. Many of the GPs, in principle, investors actually trying to relocate from New York and Connecticut over to Texas or to South Florida. So it's a big business now for us to work in this area because many people, not just the individual principal owners of the GPs want to leave, but also the businesses themselves. So that's quite some push now that we see particularly in New York.
Yeah, and I think that's going to continue because as states feel their way along, then I think we're going to see, a greater variety of responses to how they deal with this situation.
So from a real estate ownership position, and we see it with what we own, we're projecting different states in response to that. The $5.7 billion revenue enhancement bill that was just passed in Georgia, I think we're seeing as a response to that, continuing to see those state and local taxes change. Do you see more movement away from existing lower state income tax places like Florida? Is there less benefit to relocate to Florida now as opposed to somewhere like Georgia, which already has a low state income tax, and now with the federal tax savings, doesn't make any sense to have to go all the way to a no income tax state?
That's a good question. I don't know, Oliver, if you've thought about that as well. I think there's so many factors involved, but I think if you're right, if a state has a relatively low tax burden versus a zero one, maybe that's not going to push people as much. But if you're sitting in California, you're sitting in Chicago, sitting in New York, maybe you do put Georgia on the map.
Sure.
As a possibility.
Well, certainly Amazon has, because that's exactly where they're going, to Atlanta. So shifting gears a little to continue to talk about some of the implications, one of the big beneficial changes, especially on the real estate ownership side we've seen, is the change in way you can treat deductions. So we're now at 100% deduction of capital expenses in the year you spend it instead of amortizing it over some period of time. Could you talk a little further, John, about how does this new sort of 100% expensing of the depreciation regime apply to real estate?
Yeah, and this also bleeds into kind of some other discussions Oliver and I are going to have. So I think if we kind of work on that together, that may be beneficial, particularly given we don't want to be wrestled off the stage, or at least.
It's 3-on-1 charter time with this panel.
I don't know. You look pretty tough. So, one of the things that they introduced as part of our tax reform package is for certain depreciable property, they'll allow you 100% write-off in the year that you make the capital investment. And so for, it's only for assets that are depreciable of 20 years or less. And so that doesn't cover everything in the real estate sector. One of the other elements that's important to bring into bear now is that we also have a limitation on interest deductions, in that it's going to be net interest expense and 30% of EBITDA for a couple of years. And so if you want to take advantage of the 100% expensing, then you're into this regime where your interest expense could be limited. But if you want to if you want it to fit into the real estate carve out that they've enacted for the real estate deductibility or the interest deductibility provisions, then you have to forgo this 100% write-off. So you do have a choice, and it's really a modeling issue. And as people have mentioned before, some of the players coming in the market now are less leveraged than they used to be, and so there's still like a tax optimization element there when you're investing into the U.S. But beyond that, there's less of a push that you have to debt fund, and I think that will give yourself more flexibility in modeling it out. And I think that's more on Oliver's end than on mine of figuring out, is it better to have 100% expensing based on what you're investing in for qualifying assets and forgo the, get stuck into the interest limitation rules, or is it better to forgo those and get stuck with a very long depreciation cycle?
And on that point, there's another kind of tricky new rule now. So net operating losses are limited to 80% going forward, so you can only use NOLs up to 80% of your taxable income after 2017. So when you now imagine you opt in, which is an option for a real estate business to qualify for this exemption from the limitation on interest deductibility, you have to opt in on a formal form. Nobody knows what the form looks like. It's not out there. It has to be prescribed. Then you ultimately maximize deductions of interest. That's better than before. Than before, you were limited on shareholder loan only, but all bank debt was deductible no matter what. So now you have an all-in encompassing limitation rule, but you can opt out if you're a real estate business, whatever that means. So there are certain questions around what is a real estate business even. But if you opt in, that means you can deduct all your interest, clearly subject to arm's length nature of third-party comparison if it's a related party loan. But that could ultimately lead you to have tax losses every year because you maximize deductions, depreciation, and expense interest. And ultimately, that's not good. It could be not good because ultimately you might build up a huge NOL that you might not be able to use in the year of sale because it's limited to 80%. While if you didn't opt in for the exemption from the deductibility limitation, then you have disallowed interest carry forward indefinite, and you can use it in full in the year of sale if you have enough EBITDA, of course, because there's still a 30% limitation. So there's a few, again, modeling exercise, fairly complicated, that you have to compare these scenarios based on your cash flow projections, which you hopefully have good numbers for.
And back to the state and local point, I think because I read it early this morning, the Georgia bill, I think, they did not allow for the 100% expensing, but they do have the NOL limitations, I think. And so if I read that right. So again, as rates converge, where if the state rates come up to deal with, they can only tax individuals so much without getting voted out of office, and the federal rate's gone down, and particularly the effective rate with this interest deductibility and the expensing, what if New York doesn't have this rule? And so suddenly you're modeling and you're thinking about what to do at the federal level becomes a lot more complicated.
Sure. So that's at the real estate sort of owner, regardless who they are, level in the states. And bringing that into this room and outside of the country, is it fair to say that every foreign investor in commercial real estate should expect to see a drop in their effective tax rate, and an increase in IRR is a reflect of that, or is it dependent on the investor, or other factors to see?
It would be too bold a statement to say everybody benefits, but I think everybody does benefit, because most investors inbound US usually use corporate structures, because many investors, also the Germans, are very scared of having US tax return filing obligations. Nobody wants to file US tax return and be on the radar in the US, and still this kind of myth. When I talk to some people, we don't want our C-suite people to go on vacation in Miami and then be kept at the airport because somebody didn't pay tax. Yeah. So that's still somehow out there. Particularly Germans apparently have this kind of myth built up or reputation.
Oh, no, it's all over the place.
Okay. But ultimately, I think just a mere drop from 35 to 21%, if you're in a taxable year situation, it's clearly a huge saving on your operating tax burden. The same applies in a corporate structure to capital gain, because the same rate applies to ordinary as to capital gain income. And then normally you liquidate your company anyway, so you avoid the second layer of tax, the withholding tax. But clearly there are certain exceptions, because some people have heavily debt invested in the past and may have made investments into Reits, let's say a blocker corporation coming into a REIT or a partnership over a REIT. There is quite some uncertainty right now as to whether the corporation that is shareholder debt financed from its shareholders and then goes into a partnership over a REIT is actually viewed to be in a real estate business. And I mentioned the rule earlier, or John mentioned earlier, that you can opt out or opt in for an exemption from the limitation on deductibility of interest. So, and the shareholder lending was critical to get tax efficiency in the structure, but you can't hardly argue, maybe we can hopefully, that a blocker corporation above a REIT is actually viewed to be in that same real estate business that the REIT is in. So there was a submission, I guess, made last week or 2 weeks by the Real Estate Roundtable to the Treasury, Stephen Mnuchin, asking about clarification of the rule to argue that a corporation that is in a partnership over a REIT, for example, is actually can be argued to be in such real estate business and therefore qualify for the exception to the rule. That would be very helpful, because many of the big fund sponsors, the Core Plus fund sponsors, have used series of C Corp structures above a big fund, being a REIT, and they would have to restructure their whole structure to get the same tax efficiency.
And that gets to 2 points. I think one, to clarify, is this interest deductibility limitation. It does not have a grandfathering rule. So if you borrowed last year or the year before tax reform, you're still subject to this limitation. It's not just on new debt. And the other point is another one, which is whether and I'm sure there are lots of Trump supporters here, but whether you're a Trump supporter or not, they're having a real difficult time staffing their administrative agencies, including the Treasury. And so they've got this new tax bill with lots of things they have to do. And I know from some of the senior people that I know I went to law school with or that I'm buddies with, they're going, oh my goodness, we're trying to figure out what's the most urgent thing to do and issue guidance on. And so there are a lot of these issues that affect the real estate industry, affect a lot of different industries, where they're lining up and going, we need to know now, but there's a queue going around the block of people with urgent issues. And so we may not get guidance for a while just because there are very few people to write the rules and they're overwhelmed.
The main guy just quit last week.
Yeah.
So there is a big issue now that they might not expect any guidance come out anytime soon, because the main guy they hired back to help with the whole bill was an old guy who was very good actually, is now out. He resigned last week or 2 weeks ago, I believe.
Yeah, 2 weeks.
So that's a big issue. And all the guidance we expected to come out in June or so is likely put on hold. We don't know. Sorry.
So definitely corrections to come, and probably some difficult understanding of the actual enforcement for the time being. But back to the concept of the REIT structure in general. And historically, a lot of foreign investors have used debt as a way to invest in the U.S. To avoid a lot of FIRPTA and other tax implications. But with this tax change, do you see a more of an interest in foreign investors investing on the equity side than on the debt side, as they historically have?
So you mentioned REITs. That was the first question, or the part of the question. So REITs have been very interesting for the longest time. So private REITs, I'm not talking about public REITs, I'm about private REITs used by investors to accomplish two goals. Like, number one, you block the flow through of ordinary income, so you block filing requirements. but also you might have an essentially tax-exempt entity as a taxpayer, but through certain mechanisms, the REIT is tax-exempt, which is a good thing. The problem with German investors, for example, if you're a corporate or if you're a big pension fund, if you have more than 10% ownership in a REIT, you'll ultimately fall back to a fairly high withholding tax rate of 30%. So that's not really helpful sometimes, but still REITs are very prominent and have become even more prominent nowadays because of a local law change, like under tax reform bill, that a US taxpayer, an individual taxpayer like John and I, ultimately could benefit from a rate cut, because before tax reform, the rate on ordinary dividends from a REIT was about 39.6%, so the marginal income tax rate if you're in the highest bracket. Now the rate has come down to 29.6%, so there's almost a 10% rate cut on ordinary dividends. So many of the principal investors and GPs trying to kind of restructure into REIT structures, which has an overall positive impact on the REIT landscape, I would think. And REITs have not suffered from any tax reform change, I would say, except for the difference between the tax rate benefit in the past, 35 and 21, is now a little bit like diminished. But still, I think on the state tax side, REITs are still very, very attractive, because most states, if structured properly, might be able to avoid state tax leakage. So if you look at New York with 17%, roughly 6.5% combined state tax leakage, you might be able to avoid state tax, unless you have a franchise tax concept in certain states. So there are still lots of benefits in the REIT world. And then we go back to what we discussed last year, I think the qualified foreign pension funds. We can take this aside later on, but what do you think about debt and equity? I think it's...
Yeah, I think, well, I think there's more of a view that the tax bill overall was good for REITs. I guess, are we good on time?
5 minutes. We'll have one more question.
Okay. So I do think that there's a view, because particularly for the fund sponsors, people in the States are viewing this as, it's good for them, so of course it's got to be good for everybody else as well. But I think overall it still is very favorable to REITs, the tax regime that we've got now. I think we discussed this before, the qualified foreign pension area. Again, this is one of those areas where we need more clarity on, what actually works, what doesn't, who's happy and who isn't. And this also gets to this point about how the government, the administration, I think, is going to have certain priorities in terms of enforcement. And I think this is probably going to be an area where they're going to be a bit more friendly. And unlike, the statements I made earlier about with Congress, that maybe necessarily Congress isn't doing the president a favor by passing tax reform, they're doing it for themselves, and they haven't done something that's real estate friendly because the president comes from a real estate background. But I think when you flip it over into the administration, and the people that are there that he does get to hire, they may be a lot more friendly.
Sure, and certainly the hope for all real estate in general was a real estate president would be a little kind to the industry. I think, what we've heard, and fair to say that there's a lot changing in the tax law, a lot still to change, a lot of gray areas, a lot of misunderstandings, but it's been a positive. I think it's probably also fair to say that without the tax law change, commercial real estate prices would have likely stalled in 2018 because of the upward movement in interest rates and downward pressure and cap rates. We never really want to see the tax tail wagging the dog, but as was said, it should be hopefully the last push for the final continued growth of the bull market we've been enjoying in the U.S. So it's a good time to be a U.S. real estate investor.